I forbindelse med at vi har publisert et intervju i dag eller i går var det, på Patreon med Ole Petter Gjelle, som har skrevet boka Det digitale dopet. Veldig, veldig interessant samtale. Så den har vi lagt ut på Patreon, så skal vi publisere et intervju vi tidligere har lagt ut på Patreon. Så vi publiserer det i våres åpne podcast-feed. Og den her med Wayne Himelsein. Det en av de intervjuene vi har fått best tilbakemelding på av alle sammen siden vi startet, så... Jeg tror du har lyst til å høre på det. Wayne Himelsein. Og vi kutter inn der vi tok introen for om lag 7 måneder siden. Så. Ja, så intervjuet Wayne Himelsein, en merittert hedgefondforvalter, og jeg må si at det var en enorm fornøyelse å snakke med ham. Hva du synes om det intervjuet jeg tok opp?
Jeg synes intervjuet var fantastisk bra, for å være helt ærlig. Og jeg skjønner hvorfor dere på en måte klikket så godt i det intervjuet som dere gjorde, for dere er veldig sånn detaljorientert begge to og får med dere mye, så det var rett og slett kjempebra, og jeg håper jo virkelig at lytterne følger godt med, fordi det er hav av informasjon og interessante betraktninger som han kommer med. Og en av dem, det gjaldt jo liksom denne her endringen som var i fjor. Altså, med andre ord at opsjonsprisingen, altså volatiliteten, ikke steg kraftig sånn som vi har sett tidligere. Og jeg synes han gir et så utrolig godt svar på det når han sier at menneskelig natur har ikke forandret seg. Altså vår reaksjon på frykt har ikke forandret seg i årtusener egentlig. Og at det rett og slett skyldes, altså, slik at man må for all del ikke forlate sannheter da. Og det jo en sannhet, altså hvordan vi tolker frykt, og hvordan vi reagerer på frykt. Og så saken var at det var ikke snakk om at den menneskelige reaksjonen annerledes, kun at man ikke følte den frykten av forskjellige årsaker, så fikk man ikke den fryktresponsen, altså man fikk ikke det der signalet til amygdala, altså den der fight-flight-mekanismen ble ikke iverksatt hos det investerende publikum, i hvert fall ikke de fleste, og på den måten så slo det ikke ut, så det hovedhypotesen, altså han endrer ikke modellene sine, som følge av det som skjedde i fjor, rett og slett fordi hovedhypotesen, nemlig at mennesker, når det først trygt, reagerer på samme måten, og vil reagere på samme måte i 2023 som de gjorde i år 500 før Kristus, for den saks skyld. Og det var utrolig interessant å høre hans resonementer rundt disse tingene, og spesielt for de som, altså man trenger ikke være opptatt kun av kvantitativ finans for å høre på han, eller opsjoner for den slags eller noe annet, men man kan være like opptatt av emosjoner og hvordan markedet foregår, og få et stort utbytte ut av den samtalen. Jeg synes virkelig at du fikk frem det beste i ham.
Skal vi gå i gang med intervjuet da?
Gled dere.
You seem like a conversationalist, like such a natural conversationalist. I was enjoying listening to an interview with you on some other podcast.
Thank you. Thank you. That's such a nice comment. Thank you.
No, but really, I mean, are you? You seem almost philosophical in your approach. It's unusual in your field, I guess.
Yeah, I am philosophical, and that is, I think, yes, a little bit unusual. Maybe not just in the field, but in general in life, right? I mean, it's. I've always kind of stood out in growing up and being in my, going to school and such as being the more kind of philosophical or thoughtful kid. So I think that just continued into my career. I'm not sure. I think it's just, I had that difference in general. And so certainly in finance, it's also the difference. But yeah, I think about a lot.
But you come from the world of hedge funds. I guess you're a self-identified quant. And in that world, that's where I find the most interesting people, the people I like to listen to.
Oh, that's neat. Why so? Why do you think? What about that world?
There's something about this approach where you can't rely on market forces, so you can't rely on the tides, so you have to make decisions. And it's like when if you're listening to an interview and you listen to an actor speak, it's almost always very boring, because actors are by definition empty vessels. The good
Hmm.
actors are empty vessels. The people you really want to listen to are the people who wrote the script, and maybe the director, but
Sure.
often the scriptwriter. And I feel like in the world of finance, the hedge fund guys are more like the scriptwriters.
Yeah, that's interesting. Yeah, I like that analogy, the empty vessel of the actor versus the thoughtful script. Yeah, absolutely. Yeah, I mean, I think in quant in particular, and I might say that it, you don't have as much emotion. You have to be, obviously, you don't necessarily fall in love with companies. That's one big difference. Or you don't fall in love with ideas. You probably, and at least for me, rely a lot more on empiricism, or on data, and also because the data itself is ever so, or not the data, but the behavior of the markets is ever so changing. It's not a highly reliable environment for backtesting. So you have to infuse what the data says with some creativity. And so I think those two things together beget a lot of interesting outcomes, right? I mean, that it's quant is so unlike most data sciences, where you can really just pull in the data and analyze away and get real information. Yeah, you can get some of that in quant, but then something, or at least in quant finance, but then markets come and just change on you in ways that you've never seen before. And 2022 was a great example of that, where it just wasn't behaving like it did in the last almost 10 or 20 years, because the bull market is effectively over. And so if you had done all this testing and you try to be as scientific as you can over the last 10 years, suddenly nothing you do works. And so that it makes someone who is typically scientific, it forces you to be equally creative or open-minded to change, which are two things that are at some point they're not traditionally aligned, but once you can do that or work that way, then it gets really creative and interesting.
That's exactly what I thought. You're kind of almost like a philosopher in finance. It's quite beautiful to listen to be honest.
Thank
And
you.
nerds like me, who just love finance. I don't know what it is. I just love it. I love markets. I love business, and it's so pleasurable to listen to somebody who's really thought about it. And preparing for this interview, like I said before, I was listening to you speak, and you seemed like you've really given it a lot of thought.
Yeah, thank you. I definitely have. I mean, starting out just being a thoughtful person, but then being in something for, I don't know, 25, at this point, 27 years, however long it's been. If you're thoughtful and you do the same thing for decades, you end up just thinking a lot of different angles of a lot of different aspects of that thing.
Yeah.
So that's the natural way, I guess, at least for me.
So I tried to patch together your resume, because on your LinkedIn it says your current company, you're
Sure.
CIO of Logica Capital, I presume.
Yes.
So what I came to was you have an liberal arts education from Berkeley. You
Yes.
have it's unspecified. I tried to find what it was, but I couldn't.
Yeah,
And then
I was English and creative writing.
exactly, there you
Yeah.
go.
Yeah, there you go.
And in '95, you started in finance as a prop trader in Carlin Financial Group. Is
Yeah.
that your first? Did you go directly into prop trading in markets?
I was so direct, I didn't even want to go to my own graduation. So I skipped my graduation ceremony and flew off to New York because I was so eager to be a trader.
But that's a
So
quite a good starting spot you had. You must have. I mean, is this really your first experience with markets, or was it your first job in markets?
I mean, it was my first, I think, job for sure, but also experience in that it was a real experience. I mean, my prior experience in markets was, on my own computer at the time, just looking at stocks. So I don't
Mm.
know that I'd call that experience. That was just what, I believe what a lot of kids might have done with an interest in the stock market. So that I wouldn't have at all. I mean, I read the Wall Street Journal maybe, in high school, an article here or there, but I wouldn't call that experience in markets. I would call that just curiosity. And then went off to New York and was fortunate enough to find this opportunity. And so that was really my first, not only job, yes, but I think my first in-depth experience in markets.
And this being the 90s, 4 years later, you launched your own hedge fund. And then there's a big gap, which I think that you've been running money. And then when you launched Logica in 2012.
Yes.
So basically, is the timeline sort of correct, or?
Absolutely, yeah. The timeline's correct. I've been running money the whole time in kind of different ways. Yeah, so absolutely, the timeline's correct.
Did you start out as a quant, or did you grow into being a quant? Because 95, the quants were hiding in the back office, very far in the back office, with low respect, and you had the BSDs walking around, discretionary trading and traditional floor trading and these things. Did you start out as a quant, or did you grow into it when the market sort of moved towards more that style of trading?
Sure. I think absolutely. Not even I think. So positively, absolutely. I started out as a quant, but I'll say that in the sense that I started out as a quant. Period. Like in life, I started out as a quant. I think when on the playground, I was a quant. As a kid, when somebody threw the ball at me, I looked at the ball, but I was kind of thinking about the trajectory of the ball and how to optimize my hand on a football so that that the spiral would be most efficient, and the mechanics of how many inches up you kick. These are the ways I thought when I was a kid. And so I don't think I ever could not be a quant. I was a natural quant, and therefore I looked at the world in a quantitative way, and I analyzed. Therefore, when I went to Wall Street, or rather when I started trading, call it, or being at a trading desk, there was no other means for me but to quantify. I feel like a quant must quantify, right? And so that's who I was, and that's what was in my blood. There was no specifically, there were a big mix of people. There was no specific quant desk. There were a lot of discretionary traders. And as people did things, my natural way was to wonder why and think about how to both quantify and analyze history to understand that sort of behavior. And once you get into the words analyzing history, well, you've got to do that with a computer and with data, and therefore, begets the loophole of quantifying and empirical analysis. So it's just, there's no other way I could do it. That's the simple answer. And I remember it was kind of late 95, and I started trading, and I'm watching people around me, professional traders, doing things. And, here I am, before I even wanted to trade, I wanted to understand, and I wanted to start thinking about why they're doing it, what they're doing, why are markets behaving the way they are. And I recall, one funny thing is I'm going around to different people, asking them what they're doing and how they're doing it. Right. So I'm this curious kid. I'm new at the trading desk, and my first desire is to obviously learn what other people are doing and how they're doing it. And different people I talk to are obviously running, quote, different strategies. And this one's doing this form of arbitrage, and this one's doing this other kind of trading. And then, of course, in arbitrage, there's multiple forms of arbitrage. There's stat arb and risk arb and relative value arb, and go down this list, convertible arb. And so I'm listening to all these different people telling me how they're doing and what they're doing and how it's different to everybody else. And then comes along one of the first corrections I saw while kind of being in the markets every day. It was July of 96. And the market comes down for a few weeks. It corrects. And lo and behold, most of these people are losing money, are down, right? Most of these different kinds of traders. And so here I am looking at all this, thinking to myself, what's this kind of grand delusion everyone has that they're doing something different? And really, the reality is everyone's exposed to the same pain. Like, are they not admitting it, that they're all kind of in the same thing? And that really started me going quantitatively to understand, what is this shared pain, and why does everybody think that there's differences, and what are their nuanced differences, but then their shared pain, and understanding that led to really everything I do with my career. So back to that original answer is, I didn't ever go in thinking, hey, let me just start buying 100 shares of X or Y and seeing where I could buy or sell. That just wasn't how I did it. And I couldn't. Naturally, who I was to look at the bigger picture. I think I'll use the word philosophize, and then start quantifying that philosophy. And that's how I did everything in my life, and that's how I did trading.
I want to produce the movie of your life. This is an amazing story.
Thank you.
It's so vividly clear what you're explaining. This is it's quite amazing, because most people in finance are surfing the same wave, kind of.
Yes.
And when you have like years like since 2008, really, there's been a huge wave of liquidity, and it's been really easy for stupid people to get rich. Is it now changing? Are we at like a major high watermark where money costs money, and it's no longer easy to make stupid models work? So you have to be smart now. So people like you can finally shine, like really shine, like they did in the 90s when hedge funds were all the rage.
Yeah, that's a really interesting point.
I don't mean that you
yeah.
haven't performed, by the way.
No, of course.
I know
of
you've
course.
performed very well,
Yeah.
but I'm
Yeah.
wondering, is it now going to be like exponentially
Sure.
extreme?
Sure. No, that's a wonderful question. I think that you're absolutely right. There was this easy money. I guess there's like everyone's smart in a bull market is the quote I've seen before. And so yeah, the bull market, or the if you will, buy on dip mentality, is it drops down a little bit, and oh great, it's a little bit cheaper, and you buy it, and then naturally it snaps back, and there's a great recovery, and you've made more because you bought the low. And then there's the new market where the low isn't the low, and you buy the dip, and then there's the next leg down and the next leg down, and that is a different experience and environment for most people. And yes, the free money, or easy money, if you will, is over. It seems like. At the same time, I'm not at all a predictor of markets, and I don't believe in long-term predictions. There's been a lot of studies that have done to show that even across the best analysts and economists out there, there's really not much better than a 50-50 in calling markets over the long run. When I say the long run, a year, 2 years, 3 years, there's a wonderful book I read probably over a decade ago, a long time ago, called "Searching for Alpha," and they in it they talk about doing a study of looking at all these different major bank analysts, and go down. I don't want to pick on any specific bank, but Morgan Stanley and Goldman Sachs and B of A, and go down the whole list of the big investment banks, and quote what their analysts projected where the Dow or S&P would be in 1 or 5 years from that day, and where the economy would be. And across this span of decades, if you take up all their estimates and across all the different banks and dozens of them, you get roughly a 50-50 on being right versus wrong, right? And so it really shows you that nobody really knows. And I believe that wholeheartedly to be true. I've seen it in my career, because the wildest things happen, right? It's January of 2020, and everyone thinks this is a great market, and everything's good to go. And then suddenly February, March is COVID, right? And the world changes. And so things happen. Things come out of nowhere. We live in a kind of chaotic world. And so with that said, I'm going to say that, yes, it looks like things have changed, but quote, you never know. I'm as a market trader, as a quant, I'm very much more of a, actually my investors have told me this. It wasn't me who came up with this specific line. They said that I react, I don't predict. And I think that's really fundamental to a way of being in the market, is to be a good reactor rather than a predictor. Because we can sit and make predictions all day long, but then the predictions don't pan out, and you're kind of stuck, deer in headlights. What am I going to do? This is not what I thought was going to happen. But if you hone in on the skill of reacting, then whatever happens, you flow with it. And there's been many great quotations in the world that have kind of supported this idea. One of my favorites years ago was about a sailor, when the wind moves, you reset your sails. I forget the exact verbiage, but it was the same idea. You go with a flow is the simple way to say it. And so with that also in mind, I'm going to say yes, it seems like the good times are over, but it might turn right back into a bull market in 6 months from now. And then great, I'll go with the flow and ride that once again in that direction, hopefully. So that's, I think those are many sides of the same coin. But the big takeaway is it does high level seem like things are not the same in this new inflationary environment. But I just, anything could change in as time marches on.
So what I was asking was not asking you to predict, but I'm talking about fundamental structures of markets. It could go up and down, I don't know, but it seems that we've reached sort of a point where this experiment cannot run any further on a sort of a physical level almost.
Sure. The liquidity and the cheap money experiment, if that's what you want to call it, it can't run, and it's over, it's done. But then the next point is for now, right? I mean, so let's say we call it over, and so now rates are higher, and so money costs more. Therefore, everything is more difficult when it comes to finance and investing. You could have. It's funny in discussions I've had recently. One of the good metrics for measuring hedge fund performance is called the Sharpe ratio, right? So people use this metric as a standard for comparing one hedge fund to another. What's their Sharpe ratio? And in recent conversation I had, is people were making the comment that in Sharpe ratio there's a variable where you put in the risk-free interest rate, and everybody for the last 10-20 years has just left that at zero because there's been no real rate, right? So it's just been return divided by volatility is your Sharpe ratio. But now it's your return minus the risk-free rate, right? So you do 6% and the risk-free rate is 5 or whatever, and now you've only done 1, right? And so divide that by your volatility and you're not looking that good. The point is that the risk-free rate now has a fundamental, to use your word, is a fundamental game changer, right? It says that you don't just have to perform. You don't just have to do 10% a year. You have to do better than what people can earn just putting their money in a money market account. And that becomes, of course, harder. And then to do interesting things in the hedge fund world, you have to borrow money, you have to leverage, and so leverage costs a lot more. So now you've got a bigger hurdle that you have to beat when you have ideas, right? Your cost of getting to the result is higher, of course. So all that said, yes, that's a fundamental change. There's now a new hurdle in town, and of course, no longer free money. My earlier point of not being a predictor is all that is true today, and all that looks like it's going to be true in certainly in the near term or to medium term, but it's completely possible that in a year and a half from now, the Fed is back to lowering rates. That's the bigger point I was making, is that we can say that, yes, it is different now, quote, in now is in big all caps, but that doesn't mean that we're not going to be back to where we were in the 90s or last 10 years in 2 years from now. And we just never know. I've seen it all. And so that's when I want to make the highlight is today is harder. And I think today, to your earlier point, enables people who have better strategies to shine brighter. It's tough when we're doing the right thing years ago, and in the bull market, somebody else is literally just bought the S&P and they outperform us in pure return. Maybe not in having as low volatility, but they outperform us on a pure rate of return. And because they just bought the market and it was up 30%, right, or something similarly crazy. And so that's hard. It's hard to shine in the when everyone else's lights are so bright. And so now that's nicer for people like myself. Okay, it's not so easy out there. Now you see the value of a professional or the value of someone who has those expertise. But I also know that it may not last. And so we take it while it's here. We do our best, but we continue to, of course, do what we do.
Peter, who is now in Miami visiting Goldman Sachs, has a long history of trading, running several hedge funds, and always had that approach, that sort of George Soros approach, that you speak to the Financial Times at 10 past and you say you're bullish the dollar. You hang up the phone and you read the news story and you're shorting the dollar immediately. And that that ability to change your mind is so beautiful, but it's pretty rare in society. Almost only traders or hedge fund managers have that ability, I feel. It's rewarded.
Yeah, that's interesting. I mean, I look at that as just objectivity, right? Are you an objective person or not? And I guess to your point, being highly objective, i.e., not letting your past opinion weigh on you, not having what's called sunken bias, being more sunken into what you've put more work and effort into. And I see that a lot actually more in the fundamental analysis world, as somebody spent a year studying a company and kicking the tires and talking to the management. And so even if it's not as great in the end, you've put a year of your life into it, right? And so you're almost sunken into the your own efforts rather than the objective outlook of the company. All those things do tend to happen. They're known biases all over the place.
Is that why there's only buy recommendations on companies?
Yeah, I don't know about that. I think there's probably many reasons why people are naturally optimistic, and we've been in a bull market and all those kind of good things, and there's all this effort put in. Yeah, I mean, it is easier to be a buyer than a seller over time. The market has on average gone up, right? So it's this kind of natural bias of everyone that to be positive. But yeah, so I think this reliance on not reliance, this connecting or not connecting, what's the best word, is really just attachment is what I was thinking. Attachment to what people have worked on and done, and the inability to maneuver is certainly something that's very common in the world. People get stuck with their opinions and get attached to their opinions. And I think you're right. It does make for better hedge fund managers, but I think it makes for better everything. I mean, I can't think of necessarily a different industry, but if you're a journalist, I don't know, I don't know why I came up with that example, and you find you're writing a good story, and then while you put all this work into it and you love the story, but then while you're writing it, something else happens that's much more interesting. How do you just scrap all those great words you've written and start with that new thing that some people will and some people won't, and that results in, I guess, the award-winning journalist versus the other one, right? And I don't know, maybe, but over time, I do believe that being more objective and having the ability to switch on a dime and go with the facts or what is seems more powerful is a very valuable behavior, human behavior. And so, yeah, I've been that way for a long time. Maybe it's helped me. I haven't really noticed how much that aspect of me has helped me. I think it's just kind of the whole thing in a package. I see different qualities or attributes that are helpful, but certainly that objectivity is extremely valuable in many areas of life.
I read your letter to investors, the one you put out on New Year's Eve. And the first point was you got right into the meat of it in the beginning. The most baffling fact of 2022. Stocks slid through the entire year, yet VIX, or implied volatility, just hardly moved. Right now, the VIX is at 19. It's been hovering around that point, give or take, through the whole last 14 months. What do you think happened? Or can you explain it? Or does it matter why it happened?
Yeah. So, I mean, first things first, it doesn't matter in the big picture. We back to, we have to just react, right? So the question we ask most is, how do we trade this new environment, right? That's first step. But let's put that aside and talk about the why, or I'm going to call it the possible why. I don't think that there's ever a concrete why, because every time we make assumptions as to why things happen in the financial markets or the capital markets, it really is hypothesis. And I don't know that what is ever provable, but I know there's a lot of good theories out there. And so, sure, I have some theories on why vol did what it did. And I think they're good theories, and they align with the facts. And so those can be some theoretical whys. And what are those? The first and foremost, I'd say, is that vol is I'll call it, other people have called it kind of the panic asset, right? Vol is the fear asset. And VIX has often been called the fear gauge. So one of the big problems of 2022 is it wasn't really that scary. Like, just to call it, very simply, there wasn't a panic event. I mean, so what was there? There was a slow changing economy, right? And so people said, "Oh, now there looks like inflation is creeping up on us," right? And there's clear signs, and then with that information, there is going to be, or there was and is, numbers that come out that continually support or push against this inflation risk. And what am I talking about? Numbers. It's the main ones, right? We've got GDP, and we've got unemployment, jobless. We've got consumer price index, right? What are the cost of goods? So people are looking at all of these metrics, and all of these metrics are rolling out slowly. It's not like there's new information tomorrow. It's every quarter or month we're going to get a new stat, and that stat is a small influence, or a small to medium influence on this bigger inflationary picture. And so these numbers roll out ever so slowly, and then the Fed rolls out ever so slowly with what it's thinking of these slow moving numbers, and how it's gonna slowly move to it appears what's going on. So my point in all this is that there's nothing panic stricken. It's not the COVID or '08 environment, if you want to call it two crises that are actually fear inducing crises. Are in '08, people were worried whether there's going to be banks tomorrow, right? Can I get my money out of a bank? Will my insurance policy still pay? Right. These are fundamental financial constructs of the system were in jeopardy. In COVID, it was like, are we going to be alive tomorrow? I mean, talk about fear, right? Is the world population going to chop in half? That'll certainly cut down production. I mean, obviously that's a silly thing to say, but the point is, these things were extreme and panic inducing, and so vol spiked egregiously or significantly. Come now. Compared to the slow-moving, slow data to slowly adjust this potential issue, the fear just wasn't there. And more than the fear wasn't there, what I've dubbed it, in my language, in my letter, and in talking to our own investors, is what I call bounded uncertainty. So uncertainty is what we all fear, and that is what volatility in the VIX is. And we call it fear, it's really uncertainty. And the more uncertain things are, the wider that potential band. In the inflationary pressures environment, it's bounded, right? So the Fed was, let's go some months back in 22, like Q1, Q2, whenever it was, Fed's going to raise 75 bips is what the bond market's pricing in. Yeah, and what might they do? Oh, they might raise 50 bips, or they might raise 100 bips. So 75 is the bogey, and 50 or 100, which is plus minus 25 basis points, is the wild event, right? And so if all goes wrong, we're 25 bips away from where we thought we were going to be, right? And so that's just not enough uncertainty. That's a bounded uncertainty. It's an uncertainty within a range. If the Fed had come out in Q2 and said, you know what, everyone, we're raising the Fed rate 300 basis points, there would have been absolute panic in the streets. Why would the Fed do that? Is the world is about to blow up, or whatever extreme thoughts that would then induce, right? So that's not what happened. That wasn't even remotely close to what happened. That is a panic or fear-inducing event. And so I come to this total environment of slow change, facts rolling out slowly, very small boundaries around what might go right or wrong, and we get a bounded uncertainty where vol has an initial reason to pop up, but then no real fear to take it any further. So that's my grand summary. I hope that's all kind of clear to you, and that's the way I saw it, and that's the way the market, some of the trading behavior played out that way. That when there were some moves down in the S&P, there were certain moves up in the VIX, and people took that opportunity. VIX holders or vol holders took that opportunity to sell out, right? To cover some of their inventory, and that obviously muted the spike, and it pulled it down much quicker when there was a small rally a few days, or weeks thereafter. And so you get the market reacting, or the supply demand dynamics within the market certainly played out in that fashion, or seemed to align with that thesis.
I suggested in one of the episodes we had that what happened wasn't really a crash; it was just a a repricing of cash.
Sure.
So,
absolutely.
like you said, the risk-free rate, like every single balance sheet had to be repriced. So it makes sense that Bitcoin and the Nasdaq fell sort of in tandem because cash was being repriced.
Absolutely. Growth capital was no longer as cheap, so the Nasdaq had to get hit, right? The growth sectors had to get hit. There's not the same money for growth that there previously was, right?
I don't think we've ever had a situation like that where the markets drop. And that's also why, I mean, it makes sense that the VIX doesn't drop then because it's just new. Everything is new.
Yeah, I think it's the association that there's people, rely on the correlation, or I'll call it the negative correlation of VIX and S&P, right? That if one goes down, the other goes up, and that correlation itself is what's called non-stationary, right? It's not reliable. It doesn't mean just because something didn't correlate or did correlate in the past that it's not necessarily going to correlate in the future. And so people relied on, or when they think about vol or VIX and the S&P, they think of the magnitude relationship, right? If S&P is down 2%, VIX should be up 1%, or whatever that relationship is, right? If one is up, the other's down, and so they're kind of just looking at the size of the moves. Well, S&P was down 15, why isn't VIX up 15, or whatever that standard relationship would be in points. But that's not, that's too simple, I guess, is the answer. Is it's the reason that VIX was often up when S&P was down is because of the thing that drove S&P down, right? Not just the fact that there were X points down. And so in this example, to use your words, the down was a logical repricing of the cost of capital. And so that's not a panic down. And so why should the VIX react?
It's so funny because I have a question that's literally almost what you said now, which is, why has the S&P sharp move down, VIX move up relationship apparently broken down? And you sort of mocked my question, and you're right. You're right. I'm just gonna delete that.
I'm trying my best to think ahead. So
yeah, exactly. But can I ask you a little bit more practical?
Sure.
How do you actually trade? Do you trade like pure model based, where it's an API connected to a trading system that just automatically trades, or do you have like a model where you're putting human input, or do you use model as sort of inspiration for trades?
Sure. Yeah. Not inspiration. I think inspiration is I get out of books and sitting, laying awake at night on my pillow thinking about the the world in 100 ways. That's where I get my inspiration. But how do we use models? I'll call the bifurcation is black box versus gray box. We are not black box. Black box is your model spits out a trade, sends it to the API, the computer executes, and at the end of the day, you look at your P&L. That is definitely not who we are. We are a gray box, and so gray box is the melding of some discretionary overlay to a quantitative output. And so our model will scan, or if you will, scan or screen or run through, process these variables that we're interested in, look at the markets, extract these behaviors that we're looking for, and suggest a trade. And when I say suggest, it'll literally will tell us that we think it thinks based on X or Y being cheap or expensive, we should buy 10 shares of this or sell 20 shares of that, or whatever it might be. And so it looks at our portfolio, it looks at the market based on all this stuff that we want to look at. These are, there's 15,000 lines of code that we've built over the last decade that is looking at really intricate and specific things that are interesting to us, that we found to be valuable. And then it's suggesting a way to trade. So I look at that trade, and I've been in the markets, of course, for these decades. And so I think to myself, does that seem right? Yeah, it does. Okay, so that's step one. And this all happens very quickly, right? So the immediate, I'll call it sanity check. Does that seem right? Yes, done. Okay. A second later, it's all right. It wants me to buy, for argument's sake, or for an easy example, 100 shares. So I want to buy 100 shares of some S&P option. Okay, well, I don't know. I think I want to do that. Fine. The model seems to make total sense. The market, the way it's behaving, I'm staring at it. for every day, all day. It seems like that's right up what I would do personally if I were manually trading. And so I go in and buy the 100 shares. Then I get the moment where it suggests 100 shares, and I'm sitting there saying, you know what, I'm just not feeling that. I've been sitting here looking at the market, and the market looks like it just not that, right? And so I was like, you know what, I'm not going to do 100. I'm going to do only 50. And so I'll make that decision and buy half. And then there's the times where, you know what, I completely disagree with that model output. It just sanity. I just don't see it at all. I'm going to buy 0, and that's the limit. I'm not going to ever say the model suggests to buy 100. I'm going to go and sell 100. So that's what I won't do. I won't do, quote, the opposite of the model. I will do some discretionary judgment as to either the full or proportionate amount of the model suggestion, never opposite. And that's been kind of the rule for years. We like that. And then we, of course, run a empirical analysis to say, how has our discretionary overlay, every time the model suggested 100 and we bought 50, that, of course, produced a P&L the next day. How is that done versus running the model, quote, raw, and just saying, had we bought that 100 every time it suggested that 100? So it's the raw output run versus our discretion overlay run. And over time, we keep on beating ourselves. Quote, we beat the raw run of the model. So as long as we do that, we keep on adding discretion. If we ever find that the model starts beating us, then I better stop just adding discretion, because I'm not as good as what the model's outputting. And so that's the full answer. And of course, in greater perhaps depth than you asked for.
No, it's exactly what I wanted to know. It's often the practical answers are often the hardest to come by, and that's a very good answer. And I think also probably when you look at literature now, it's probably the closest to best practices right now, where you have this supercomputer sitting, going through the data. If it's an AI or whatever, it doesn't matter. But then you ultimately make the decision based on experience, because if not, why even be there?
Absolutely. And I've had some wonderful philosophical discussions with people over, what is experience? What is human experience? And at the end of the day, our brain is a computer, right? So, it's just a different processor. And it's, our experience means that we've seen something happen a bunch of times. We found it. Our brain has identified a pattern, and that pattern, perhaps because we're emotional creatures, we feel that pattern in our gut. Right. Well, okay. So the computer feels it in its, in its transistors. It's just doing a different form of processing. So are we better? Are we worse? And will there come a time, people have asked me, where all that processing power and all that experience in our brain will eventually be caught up in the of course pure computer processing world, whether it's quantum computing or even before that, are processors good enough to start seeing everything we see? Quote. And it's such a, of course, interesting question in general, AI across all industries, but specifically in finance. And what's funny to me about that is, if you think about we project that out far into the future, and yes, it can. The computers will be able to do everything. Well, then how do the computers compete with the computers, right? That's the big question. Is some computer has to be smarter than some other computer. Otherwise, all the computers are just one giant curve-fitting machine, right? And everyone's just trading to what the same patterns. And we go back to, of course, where this has happened most clearly is in the game of chess, where I think it was when Kasparov beat Big Blue some decades ago, and what he did, and it was something I read about the process afterwards, is he saw the way the computer was competing with him, and recognized that it was definitely going with the highest probability move each time. And he realized this, so he thought to himself, his next move was just going to be something kind of more silly, like really different, that wouldn't make probabilistic sense. And so he made a move that then the computers was kind of confused and like, what, like, why would you do that? Like, that makes no sense. And it wasn't expecting that. So it then did something really wacky. And then he used that to turn the game around and win it. Right. And so it's
pretty funny that you use this example, because this is probably the most recent strategy shift from the Norwegian chess champion Magnus Carlsen, when he's facing young players. Because young players play, especially like young Indian players especially, are incredibly sharp, and they know have so much detailed knowledge. So it's very hard. It's almost like playing a computer because they are so strong.
Right. They know
But what
every
he
setup. Yeah.
exactly, but what he has discovered is if he plays, like you said, wacky, and you can play really wacky, really weak moves, if you do it the way he has experienced, and you can see it in the way he's playing. He's trying to break the line, and that's funny that you bring up that example because that's something he has discovered playing humans that play like computers.
Yeah. So right, same thing, right? And so that's how in finance. That's I don't know. You know, it analogizes to me in some way where the computers can't. The human has the ability to do that, and of course, maybe one day a computer will have the ability to do that, some form of AI. But right now, our ability to do that is, I guess, there's just more variables than there are those being processed. That's how I would summarize it in my model. What is it that gets me to override that the model suggests 100 shares and I only want to buy 50 at this moment? It's because I know I built the model. I mean, obviously with my team, but we know the variables it's looking at, and we know how it's looking at it. Right? We designed it. So by definition, if it's only looking at, for argument's sake, 5 variables, my head is processing everything I've ever known, and I don't know how many variables live in that processing, but it's everything, right? And so, and my ability, or our human ability, to say, well, let's be wacky, as the chess players did. Let's go with a wacky route and throw things off. That nuanced ability is where over time it makes sense because the world is so I guess dynamic, and so certainly the financial markets and so interesting. So yeah, I think that it, and as we've seen empirically, it adds value. Like we test it. You know, are our decisions helping? Yes, they are. Okay, continue deciding. You know, even the discretion is quantitative. That's the beautiful thing.
There's a book. I know I'm breaking protocol a little bit by how you're supposed to do the interview, but I really want to recommend a book to you called The Gift of Fear, which talks about. It's a very short little book, but it talks about gut feeling, what it is, and it's exactly what you're describing. And I think it could be like a real, true secret weapon for trading, where your gut feeling is really a supercomputer in your head that is completely like not in your conscious mind. But it's very interesting what you're saying. It's super interesting.
Yeah.
And I think you're right. But my next question, when you say that you override the model, do you then edit the model with your override?
Right. So
Do you optimize it?
yeah, of course. So there, of course, is one of the biggest issues in quantitative finance is overfitting, and it is both necessary and dangerous, right? And it's just the answer is yes and no, right? Because yes, you have to continuously optimize or react to the new environment or the new behaviors of the markets. At the same time, you can't do it that quickly because things can be very short-lived. You can't overfit because it tends to not work over time. Markets do have some, I guess I'll say, different behaviors at different frequencies, right? What I mean by frequencies is obviously the time span of that behavior. If you talk about something like momentum, right? Momentum is a grand behavior in the market. It's not going away. That's, you know, it might pause for a year, but it's not going anywhere. Why? Because it's based on the way people behave. And as long as markets are traded by humans, then there will be momentum because people get on the train and everyone gets excited, and the stories proliferate through the news and through the media, and everyone loves Tesla and Apple and however long that went, and they all talk about with their friends and buddies at dinners and lunches, and at the end of some number of however many years that goes, that momentum accumulates. That's the way the market will always be, by quote natural human behavior. Just as a quick tangent, there was a great paper written in 2014, a Wharton study that studied momentum, and they called it, the name of the paper was quote the longest backtest ever done, right? It was a 212-year study into the financial markets, where they found that over 212 years, the most persistent behavior was momentum. Right? And they talk about why they call it the most persistent anomaly. And of course, what's funny or ironic is if it's so persistent, it's not an anomaly. It's just the way things are. But put put that aside. So we have behaviors that are fundamental to markets that we understand and that won't change. So the variables that look to those behaviors at those frequencies, we're not going to adapt. Even if they're not behaving or not doing, quote, as they should for a few days or weeks or even months, we're not going to change them because I know there's momentum in the market and I'm going to wait for that signal to do its job. I'm not changing that signal. Then there are other signals at tighter frequencies, shorter term behaviors. For example, we could talk about vol and what vol did in 2022 versus what it did in the prior decade, where the relationship between the S&P and implied vol, or S&P and VIX, had a stronger negative correlation in prior years. Well, or I should say in the prior decade or two. But in 2022, that negative correlation was weak. So do you change that piece of the model? Well, once again, yes and no. This is a wonderful example. No, because as we talked about earlier, the fear is still there in humans. It was just not a fear-inducing event. So we're not going to change the fact that, quote, vol or VIX doesn't work. That's silly. It does work. We just need a panic thing to happen for it to properly work. What we need to change is now while there is not a panic event, right? So while during the course of a year where that hasn't happened, we have a problem because VIX or IV is higher. It's in the 20s rather than the teens, and it's not spiking very much, right? So it's more expensive to carry, and it's got a smaller range, and it doesn't look like it's spiking much. And so it's got this other behavior that's inconsistent or different to the behavior of the prior decade. All right, so that means that we have to adapt that shorter frequency part of the model, that part that looks at how it's behaving right now, so that we can trade it better tomorrow, so that we can react better. If we change our expectation that the negative correlation is, for example, is not as strong, and just to be clear, we don't use correlation in our models, but I'm just using it because it's easy to talk about. So if the negative correlation is not as strong as it was in the prior years, if S&P down 1 doesn't make VIX up 1, it sometimes even makes VIX down during 22. Well, then if someone had negative correlation in their model, then they should pull that out. Then they should set that variable aside during 2022, because that's not working. And that's where I believe optimization is key, is let's try to figure out this new relationship and work with it. But don't change this fundamental fact that you want to hold a bunch of long vol into a panic event. That hasn't changed, right? And so I come back to this grander idea of different variables or different insights being associated with different levels or frequencies of the market in different time horizons, et cetera. And some are more powerful and consistent, some are less powerful and move quicker. So our model adapts, or we will make a change that we let me back up a second. When we see these things changing, we have meetings, we have brainstorms. Me and my team of there's 3 of us on the investment team. We'll talk about it and say, hey, is this year 2022? We had so many discussions. Is this normal? Why is it not normal? What is it? How anomalous is it? Is XYZ reliable? Is it not? And let's look at this data. And okay, I'm not sure about this. Let's study this over the last 100 days and see, just get some information here. And so we go back and forth. We have these discussions, and we see that this one more, quote, local variable is not behaving. All right, let's change that. And now we've noted that we've changed it, and the model starts behaving better, meaning it starts identifying or suggesting trades that are working better, where I agree with them more discretionarily. It suggests to buy 100. I'm like, yes, I would totally buy 100 here, right? And so we've made a little change at the local level, and it now it's playing itself out better. So we feel that that's right, but we're hyper aware of the change we've made. We have a note of it. And as soon as we see it not doing as well as it was since that change, we're willing to move that variable or adapt that variable once again. We will not go into the core of the system and start changing things that we built years ago that took 3 years of thinking to understand certain relationships that we rely on. Because those are the, quote, momentum pieces of our model that are baked into the way markets are, and we know that. And even if they don't behave or lose us money for some amount of time, we stick to them. And of course, just as a trailer to this, is we got into that early discussion of being quick to shift, and how objective one is. we try to be super objective. We don't want to be too quick to shift, but we're quick to shift where we know that the impact is small. We're less quick to shift where we know the impact is big. So I hope that, I mean, it's a very multi-part answer, but I hope that kind of gets to where you were driving, and let me know if you have more questions along those lines.
And I can notice that you're significantly more emotional now, talking about markets, talking about in a good way, I mean. But how do you control your emotions when you trade? Especially since you are trading in a way, since you're trading volatility, you're in a way trading emotions as well. And in options is, I mean, you're trading insurance, depending on how you want to put it. How do you control your emotions, or do you have to control your emotions?
I don't have to control them, in that the way I am is emotion controlled in those moments. So I don't know, whatever happened to me in my life as a kid. I grew up in a certain type of family, a certain type of parents that treated me a certain way. Whatever the results of that is that when I'm in a moment of stress, I can control myself very well. And if we were on a sinking ship and I'd be the one saying, like, okay, everybody, like, grab this, grab that. Suddenly I'm that person, and I kind of always have been. That in moments of stress, I'm not stressed. And what I always do though is I'll call it like a caffeine high and then a crash. Is I'll not be stressed during the stressful moment. So if the market's open and I'm in it and my eyes are just wide open and I'm focused and I'm doing what I should be doing, and I understand what I should be doing, I follow my process, and then the market closes and it's all done, and then I'll just go and lie down on the couch and just like, oh my God, that was so intense, right? and then I crash, and then I can go through even some panic, and then I have to call someone and talk about something that just happened if it was that intense. And I have, certain people that I talk to that are my trading companions, if you will. And we have discussions like that. And I'm like, I feel it inside, and my heart is pounding, and, but that's all after the fact. And so once again, I've always been this way. It's whatever happened to me in my life. I can deal with stress very well. I don't look at making or losing money as being, it doesn't joggle me at all. And it's funny because I have on the screen my P&L, and it's moving up and down millions, right? And it doesn't phase me. It's not like a number. It's not a money amount. It's just a green line, right? Or whatever, or a red line at times, right? So, or red digits or green digits. And in that way, I'm emotionless to the numbers I'm staring at and what they're doing, and really trying to make the best decisions. But certainly, being human, I will have my times, and it could be at night, it could be on the weekend, where it all comes together, and I can even go on for days or a week during a bad, like, an environment like COVID. Like every day, it's so intense, and I'm loving it and I'm into it. And then, like, that, it's March 20th and the market bottoms and it starts rallying and things look like the world's not going to end. And then I just want to go away for the weekend, and I just need a break, and then start processing and thinking about all those reactions that I muted during the experience. So I don't know if that's a good or bad thing, or I shouldn't say that. It's not good or bad. It is the way I am, and I'm happy with it. It enables me to do what I do in a better way. And I certainly, to your first point or to your first question, I certainly do have emotions. They're just delayed. And that's, I think, for me, a very helpful thing.
It's a little superpower there.
I think so. I hope so. It certainly has worked out.
But let's do the last, 10 days. There's two weird things that happened.
Yeah.
So you have last Friday, you have the 0 day to expiry options in a number of shares going crazy. And then Lucid Motors is probably the biggest one, but you have very large shares like Tesla going nuts, and you have a number of different shares behaving as the tail was wagging the dog in a way. Yeah. And then you have the error on the New York Stock Exchange. That was, I forget which day it was last week, when they were misquoting a bunch of shares, and there was a human error apparently. Yep. And but there's some confusion, and people get unsure, especially like lose a little faith in the market, and you don't know if the ground beneath you is shifting or not. How did you respond to those two specific events, or did you even notice them?
I did not even notice them. As you're telling me each one, I was like, oh, really?
That's great. It's for people like me who make a
Yeah,
podcast and write a blog.
exactly. Yeah.
It's
I'm
like great father, but
yeah, yeah. I'm like, oh, that's interesting. Tell me more. Yeah.
so then that's interesting because like people talk about the VIX and they're trying to explain like why is the VIX not moving? Why is and then they say, and I even wrote this down. I'm going to bring up my notes for this. So I wrote this down from the FT. Because the VIX uses options that mature between 23 and 37 days to calculate the 30-day implied volatility.
Yep.
And there's a huge influx of 0-day to expiry volume because people, I guess it's working. Or so you look at the last year, it's I think it's up 50-60% the volume. But we're not seeing that in the VIX because it's not calculated or it's not impacted much.
Yeah,
do you have any opinion on this? Or
yeah, I mean, first of all, volume is two sides, right? It takes two to tango in a trade, right? That's always, it's always fun to me, like that there's so much buying in the stock. Well, for every buy, there was someone who sold them those shares, right? So whenever you read
CNBC always says more buyers than sellers, though.
Yeah, but there's not more. They're always equal. All right, it's the fundamental fact is every buyer must buy from a seller, right? And vice versa. So there's never more buyers than sellers. There's never more sellers than buyers. There is, I mean, when I say there's never more, at that moment there might be more sellers than somebody's. But there's always a buyer. There's just what the eagerness of either side is, right? So it's not more or less. It's how much more or less either side wants that position. So I want to sell more than you want to buy, so I'll push down further. You want to buy it more than I want to sell it, you're going to bid up more, and I'm more casual because I'm not so interested in selling here. So you got to wait for me to meet my price. Eagerness is the issue, not quantity. But that said, let's go back to your first. The core of your question is these little things that happen, and so all this, it's the expiry day, and it's the gap down stock of the misfire on the Nasdaq or wherever it was. All of this stuff, these call it mini news events, and like you said, you see them in the news and you write them down, and they're impactful, but they're impactful to somebody who very specifically trades that thing, right? So for us, for example, the options expiries, right, and triple witching and all this stuff that goes on, the different rolling calendars and all this, and expiry calendars and the weeklies versus the monthlies and the quarterlies, and I don't care because I don't trade that part of the structure. That's the vol structure. I don't trade the vol structure. I trade volatility, right, as an asset class, it's movement. I'm a range trader of volatility, the S&P itself. So if it comes to expiries, some specific hedge fund who loves that nuance of the trade, they trade that, they take in that data, and that influences decisions they're going to make. But that's only relevant to them. Truly, it's not relevant to the public. It's not worthy of being a headline or even a mini headline because it's not going to make a difference to you. And let me put it in a different way. Let's say some Friday in 3 weeks from now is this weird expiry triple witching day, and so all these different options are doing different things. But that Friday morning, there's some other whatever it is. I don't know. Tesla beats earnings just for some silly unrelated event. Well, whatever the witching was going to cause, the market's going to be more excited or influenced by the Tesla earnings, right? Because they were so outsized compared, and so growth is now exciting again. That narrative will overtake the expiry thing in all of 3 seconds, right? And so the problem always is there are so many influences in the markets. There are so many things going on every day. I don't know that the way the VIX behaved yesterday was because there was some glitch on the stock exchange or because there was some expiry function. It could have been because the home builders beat and their home builders are up and people who owned options were a lot of the real estate people. Who knows? There's just so many moving forces. And so I don't like this, I'm going to call it attribution that the media does of this is the effect of this, and this is the causality in markets is way more complex than people realize. I don't watch CNBC because I honestly, it bothers me how much they attribute this to that, and the move today was because the whatever happened in some part of the world. No, market moves up and down, and so many influences. And if you're trading that thing, if you're a currency trader, then you want to know about this international event. Otherwise, don't worry about it. Do what you do for your investment process. And whatever that is, if your investment process doesn't involve expiration dates of options, then stop paying attention to it, right? And that's my best advice for most investors is learn more about your own process. If it's a fundamental process and you like understanding companies and their growth potential, then read more and do more about that, and stop reading about expiration dates of options. It's completely irrelevant to what you do and how you think about markets, and it's all there. Just I'll call it noise in the media, and so that's not only for even something as specific as options traders like myself. We trade vol, and I don't care about expiration dates.
You didn't even know.
I didn't even know. I don't. It's irrelevant because that's exactly.
There isn't. I mean, it's price action versus narrative, like an age-old debate. But every once in a while, the narrative matters. But like you said, it's rare, and maybe it won't matter to you. So who cares?
Yeah, I mean, the narrative matters in obviously something grand or massive like COVID, right? So sure, will it shut down the world economy? Yes, that narrative, of course, it matters, right? So I'm not blindly swiping all media, but the little things tend to matter less.
I love that everyone in finance hates CNBC. Isn't that funny? I've never met a single person that likes CNBC.
Yeah, I mean, it's entertainment. It's
not that entertaining either.
Sure, I haven't watched it in so long I don't even remember.
Can I ask you about one last question about your models?
You can ask me anything.
One last question about your models.
Yes.
I don't know if you even think about this, but have you looked at the half-life of your models and models in general? And is that half-life like the half-life of the effectiveness of models?
Sure.
Models in general and models specifically. Is it changing? Is it plateauing? Because I know it was coming down for many people for many years.
Yeah, I think that all gets into the discussion that was had before. I was getting into the examples of overfitting and optimization versus frequency. So I think the half-life or decay of a model is obviously a function of how granular and how it's looking and kind of the frequency of its focus. So model, go back to the topic of momentum, which is this long living or forever living anomaly or behavior in capital markets, relying heavily on the way people are, the way humans are. Well, that doesn't have a half-life. You have a momentum model, it works and it'll continue working. Now, how you trade that and the fact that momentum can be out of favor for 2 years and you have a business to run, and so you don't want to have 2 years of weak returns, and then you need some client relations department to explain to people, why that the market's out of favor. I mean, AQR went through that for a long time with growth versus value, right? That hurt them for many years. And they stood behind it saying growth and value are fundamental constructs. And we believe this was, and they took the drawdown and eventually it switched the other way and they did amazingly well.
Yeah, Cliff Assis loves to argue with people on Twitter.
Right, exactly. And I respect him greatly for being objective but to a grand thesis in the market, not to a local modeled behavior. Right, and that's the key difference. And I'll say that one more time: is that the models that over optimize to local behavior, a lot of these quant models are that they're going to have a very fast decay rate because there's so many people doing quant. There's going to be, of course, searching for the same alpha, and therefore people are going to kind of step on each other's toes until the arb goes away or the inefficiency goes away. That's always going to happen, right? There's just so many smart people looking at the same environment, and so we're going to find the same things, and so we have to be kind of always steps ahead of each other, else we're all going to find the same arb, and then the arb's going to close itself by the number of participants trying to get at it first and jumping in front of each other. So that, of course, calls for decay. Then markets will change naturally, like 2022 versus prior years. And so that's going to create decay in models and other different types of changes. But all of that is, once again, a function of how local the model is and how optimized the model is. So the more optimized and the more local a model is, the more it's going to, the quicker the half-life. And of course, the less optimized and more broad and conceptual the model is, the longer lasting it is. And that's why, for me, I love simple models. I love broad scale, deep market behavior. Yeah, when we first started talking, we started talking about how I'm a bit more philosophical, and I think that at the core of my models are deep philosophical hypotheses, and they're not changing. And I see them, and I understand that I have to create mini models to maneuver around the ever-changing local environments. But the ever-changing local environments are mini models that are constantly being optimized to try to stay on top of the grand model, which is the core thesis that we rely on. So and that one, once again, goes back to the yes and no. Do half-lives, are they getting faster because there's more people competing? Yes. But does that affect these grand models that understand market behavior at the core? No.
Having read at least a fair amount of your work and listened to you, it appears that quotations are quite important to you. And I think that you maybe collect them. I know a lot of people in finance collect quotes.
Absolutely.
Do you have a favorite quote?
Oh my gosh.
That's a terrible question to
end on.
That's a
terrible question. Yes, about 1,000 of them. Wow. I have so many. I collect quotes, and I have different sheets of course, like topics, quotes on different topics. So I have favorites in every different area. Man, that's a tough one.
Why do you think people in finance love quotes so much? Especially hedge funds. I don't know what it is, but are there eternal truths?
I don't know if there's eternal truths, but there's, as humans, the human condition is we've all been through the same stuff over and over again, right? And I always think it's funny when I hear people or I watch movies and they're like, "Oh, it's like the good old days." There's nothing different in the old days, right? In the 1930s, people were the same people as they are today, and we just had
Jesse Livermore. It was the same exact thing as today.
Yeah,
only difference is where he traded, but everything was the same.
Exactly. Yeah, and everybody had the same increase or decrease in like, so today we all have computers and real-time quotes, and Livermore had called up the broker to get a quote or use the ticker tape. Well, at that time, everyone had a ticker tape. So everyone shared the same speed of the medium. And at that point, the speed of the medium, people were trying to beat that speed by getting faster ticker tapes, right? And today they're getting supercomputer, right? So it's the same competition at the same level, but everyone's constrained by the same bandwidth, right? And that's been the case throughout history. And once again, that's why I said earlier with momentum, we are all humans, and so we always do the same thing, and we're always going to chase because we are humans are chasers, and news and information kind of disseminates around the world, and we all get excited about the same stocks, and they run up. And of course, the stocks at the core are beating earnings quarter after quarter. So there's this fundamental piece that we all look at that bleeds its way through into the narrative. In any event, why quotes? Quotes for me are, it's not that there are these truths, that there's these things have happened all the time, and when somebody comes up with a great way to put it, I love that. And as you went back to your very first question for me earlier is what I studied in college. I was an English major and creative writing minor, and I love words, and I love being able to put an idea into a concise, beautiful sentence, and it just seems like something that says it so well is easier to remember. It's easier to absorb, and to spread around. Quotes, I guess they spread easily, right? If you can say something beautifully in a little sentence, it can disseminate much wider and perhaps have more impact. And I know for me, it's just, I love the way to put things. And actually, you asked me my favorite quote. I think it just came to me of all of them, and I don't have the exact quote in front of me, and it's in one of my sheets, but it's to rephrase it. And it's terrible that I'm rephrasing it because it's a beautiful quote, but it is very simple. I think it is from an ancient, or not ancient, but a Greek philosopher. I forget which one, but it's in the Socrates days. And he said very simply, education is freedom. And I just love that, because I think if I attribute everything I've achieved in my life, it's education. And it given me the way to think that I think. I read and I read and I read and I read, and people come to my house and they see my shelf full of books, and they're like, "Oh, you got a lot of books," and they open them and they start, every one they open has highlights in it. And they're like, and they put it back, like, wait, and they grab another one and they open it, and there's highlights and little, little earmarks on the pages are folded over, and they look at me and they're like, you've marked every one. I'm like, yeah, what else are they there for? Because most people's bookshelves are full of books, and some of them they've read, some of them they haven't, and mine are all read and absorbed. And I love what that's done for me in my life. And I think I've become as good as I've gotten, as an expert as I am at what I do, all from just absorbing knowledge at a high rate, and wanting to, just super curious, and wanting to learn how everything works. And so that is my, I'll call it all-time favorite, because it really resonates. And I hope it does with others too, because I want that for the world.
Thank you so much for a wonderful interview. It was genuinely incredibly satisfying just to listen.
Thank you.